Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate given away during this show. And that certificate is not sponsored by the radio station, but by Tan Bella Tanning Salon with 2 locations in San Francisco and 1 in Marin. And the weather's starting to heat up, so you'll want to get your tan on. Today's trivia theme is baseball numbers. We'll do a little sports today. Today we have a special guest, Annie Dickerson of Good Egg Investments. Annie is an award-winning real estate investing expert with 15 plus years real estate investing experience. In 2022, Annie was named Real Estate Investor of the Year by The Motley Fool. Wow, that's impressive. Annie and her business partner, Julie Lamb, are the founders of Good Egg Investments. We'll have to get into that and find out how that name came around. An award-winning boutique real estate investment firm, which was named Best Real Estate Syndication Company in North America by Build Magazine. Together, they have helped thousands of investors around the country to invest in commercial real estate assets totaling over $1.3 billion. Annie and Julie are authors of the book Investing for Good, hosts of Life and Money Show podcasts, and creators of the Real Estate Accelerator. Hey, Annie, I like that. I like that background. Welcome to the Best of Investing.
Thank you. I'm thrilled and honored to be here with you and your listeners today.
Well, thank you very much. First of all, okay, how does the name Good Egg Investments? How does that come up?
Yes. So it's very simple. It means build your nest egg while doing good. And so the whole premise of Good Egg, the vision when Julie and I initially launched it was, we like real estate. We ourselves are real estate nerds, but we also understand that it's not just about the real estate. The real estate is a vehicle to help people create their ideal life by design. And so we saw real estate investing as a way to help people to create wealth for their families and also to make an impact and do good in the world. So hence Good Egg.
There is definitely that feel of impact investing, which for the audience, if they're not familiar with that term, it's where you can invest but also have a good impact on the economy. In fact, the company I do a lot of work with, Pacific Private Money, who's the sponsor of the show, they actually are kind of considered the impact investing also because during the downturn of the 2008, 9, 10, 11, et cetera, there weren't many banks that were going and lending in certain areas, but Pacific Private Money was one of those lenders. And so they actually had a good impact on the community. So I like that. Very good. Tell you what, we've got a few minutes before our next break or our first break. So give us your story of how you got started in real estate.
Yeah, absolutely. Well, first of all, the first thing you should know about me is I never intended to get into real estate. In fact, I started out about as far away from real estate as you could get. Started out as a 4th grade teacher with Teach for America. I had big dreams for closing the achievement gap, the opportunity gap. And so started out teaching 4th grade. And then I decided I wanted to have an even greater impact. So I left the classroom to make educational games. So I actually went back to school to study video game design,
Really?
if you can believe that.
Yeah. Okay.
And so funny story is that when I went to game design school, the last game that I remembered playing was Super Mario Brothers. And so we went into these game design labs where all of the other students in the class had been playing games for years, PlayStation, Xbox, and whatnot. And they handed me a controller. First of all, I'm like, wait, controllers don't have wires anymore. And second, I looked down, I'm like, wait, there's 2 thumbsticks. I have to use both my thumbs. So it's quite an evolution for me.
I'm old enough to remember when Pong first came out.
Yes.
So, yeah.
Video game players have much more finger dexterity than they needed to have back then.
True.
But so then I went from game design into instructional design, creating trainings for companies. And the real estate thing really came out of left field. I never intended to get into it, but my husband became a real estate agent when we moved to the Bay Area where we live now. And as soon as he did, I crossed real estate off my list because I said, well, we can't both be in real estate. We can't be that couple. But as life would have it, as his business progressed, he said, hey, why don't you, in your spare time, maybe help me with my business? And
Let me ask you, let me interrupt for a second.
yeah,
What year was that?
that was 2016, 2017
Okay.
timeframe.
That's a good time to get
And
in.
so we had been kind of house hacking on the side. It was always something that we did. But I never really thought seriously about real estate
Uh-huh.
until I helped him with his business.
Wow. Okay. Well, we're going to cut to our first commercial break. Now, I don't know how much you know about sports, and usually I have general questions. This one, yeah, if you're a baseball fan, you'll do well on this. If you're not, maybe
This will
not.
be interesting.
It'll be interesting. Exactly. Okay. Our first commercial break trivia question here. 511 is a famous number in baseball. And there's actually two reasons. One is probably a little more obvious than the other, but we want to find out if you know the answer to this question. 511, talking baseball numbers. 511 is a famous number in baseball. Why? You've got to give me two reasons for that, all right? Call 888-912-1190. The first caller with the correct answer wins that tanning certificate, which is worth over $100. Stay with us. The Best of Investing. I'll be right back. Don't touch that dial. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with my special guest, Annie Dickerson. Our first trivia question, we're talking baseball numbers here. See if you know this. 511 is a famous baseball number. Why?
I gotta guess that maybe it's the number of home runs hit by somebody.
Well, actually, and
famous.
that to me, that's actually the harder answer. That is
Ah,
correct. Mel Ott in the 1930s, I believe it was.
interesting.
Okay, but the other one is that's how many wins Cy Young has, which to me, in all of sports, I would have to say that's probably the one record that, if I had to say one record that probably will never be broken. I mean, records probably get broken all the time, I know, but I would say that one probably would be the one. I would say, I don't know if that'll ever be broken, because if you think about it, if someone wins 20 games a year in a year now, I mean, that's like phenomenal, because pitchers are taken out all the time. They don't get a chance to even get a win, right? Well, think about it. If in order to break 511, you'd have to do that for over 25 years in a row.
Wow.
Guys generally are not going to be pitching every single year, but that's because back in his day, they pitched double headers and they didn't have as many pitchers and stuff. So
Wow.
anyway, all right. So back to real estate and business, because our special guest, Annie Dickerson from Good Egg Investments, excuse me. So let's go on to the next question that you had sent us. What's the difference between active and passive investing? And how do you know which one is right for you? Because when I read your bio here, you're mostly specializing in commercial real estate. Is that right?
That's right.
Okay.
Yes.
So do you not do anything with residential real estate, or go ahead?
That's a good question. So when I first, I mentioned I helped my husband with his business, and in the process, I fell in love, not with what he does, which is sell residential real estate, but I fell in love with investing in real estate. And so first, I actually started out looking at small multifamily properties out of state. So like duplexes, fourplexes, long distance investing, because as you know, it's really hard to buy a lot of those here in the Bay Area.
Sure.
And so we started investing out of state, and it seemed to be going well until it wasn't. And we dealt with things like theft and vandalism. I remember there's one time we had a fourplex, and one of the tenants, before they hadn't paid their rent for months and months, so we finally were going to evict them. And the day before the sheriff was going to show up, they actually left their unit. But before they left, they stopped up all the sinks and the tubs and they left the water running. And then they took off. So by the time anybody found out, they had flooded not just their unit, but the unit next door and the unit next door to that. So 3 of the 4 units had been flooded.
Wow. That
And
is good. I hate horror stories like that because, it's one thing if I mean, that's just vandalism that doesn't help them at all. At least if they, stole, a sink, then it's
right.
like, okay, we replaced the sink
Sure.
and all that. But I mean,
Mhm.
that's vindictive, where,
Yeah.
just don't, it's like graffiti and stuff. It's vandalism that doesn't do anybody any good. My goodness.
Yeah.
How much in cost and damage was that?
Well, it was my first lesson in learning how insurance works.
Yeah.
And so we had insurance, thankfully. So that ultimately covered it all. But what I didn't understand about insurance was we had to cover the cost up front. So it was about $50,000 worth of damages, which we had to front the cost for. And not to mention, I had 2 young kids at the time, and I was on the phone with the insurance company all the time to try to figure this process out.
You pay for it and then get reimbursed.
Yes,
Was there a
exactly.
high deductible on it too, or they covered all of it?
Yeah, there was a deductible on it, but
Yeah.
ultimately, yeah, we made out okay. But here's what I learned about that whole process is that is what I consider active investing, where I was managing the property myself together with a property manager who's there locally, but still I had to make all the decisions around the
Yeah.
tenants, the evictions, the turnovers, things like that. Whereas with passive investing, that's where, I can invest my money together with a group of other people. And now we buy something like an apartment community, not just one fourplex together. And so as a passive investor, I get to put my money in. I don't have to do any of the work. And I put my trust in a team with a strong track record, and they do all the work, the renovations, they manage the property on my behalf, and I get to share in the return. So that's kind of what I learned along the way. I didn't realize that those opportunities existed, but that's what we specialize now in at
Well, it's
Good
not
Egg.
like that's basically it's a syndication then, right?
It's exactly, that's right.
Okay,
It's a group investment.
yeah, property, um, prospectus, right?
Yes.
Okay, so
Yes.
it's you and it could be a whole bunch of other people.
Yes,
Yeah, gotcha,
exactly.
gotcha. Okay, so as long as you have faith in those operators,
Right.
yeah, then because it's just the same thing. Like when you hire a manager, that
Yep.
is so important with especially with apartments is making sure you have a good manager. So
Exactly.
uh,
Exactly.
interesting. Now, and then so you're just strictly being the passive investor. Are you bringing other people with you, or is just you're one off? You're just the investor along with people you don't know.
Yeah. So now what we do at Good Egg is we are the syndicator. So
Okay.
we put together, when Julie and I got together, she and I both had a passion for helping women and moms get into real estate. And we realized that passive investing is such a great way for families, busy families, to be able to build their wealth without having to do all the work of being a landlord. And so now we are the syndicators. We put together these offerings and
Oh,
we give
okay.
these passive opportunities to others.
So now you're kind of back to managing, but you're managing on a different
Exactly.
level.
Oh, I've got people for that now, Edward.
Yeah, exactly. What's interesting because it's funny, one level even more passive than that is what we do at Pacific Private Money. We're just a lender. So we don't
Yeah,
get involved with any of that stuff.
exactly.
We just strictly, we'll just lend the money
Yep.
and only if something goes topsy-turvy where we have
Yeah.
to foreclose,
Yep.
it's coupon clipping, as I say, mailbox money. And
Exactly. And
yeah,
you're at the front of the capital stack, so you have
that's
very
it.
little risk.
Yeah, that's right. Exactly. Because we're doing very low loan to value. Well, not very low, but I mean, roughly 65% loan to value, except that we
Mhm.
actually have a fund. I just coincidentally happen to be one of the managers of, so I'm a little biased, but
Mhm.
um,
Mhm.
the average loan to value it's unlevered, is 44%.
Oh,
But
wow.
we're buying loans at a discount. So our investment to value is under 30%. So we
Wow.
actually have to work hard to lose money in that.
Yeah.
We're paying a flat 8.5%. Okay, but it's not about me. We're going to be talking to Annie a little bit more. We're going to cut to our
Hey,
next.
that sounds like a great investment. Sign me right up for that.
Yeah, yeah. We have a lot of. I'll tell you the bad news when we come back. Okay. All
Okay.
right. Second trivia question: baseball numbers. 714 is a famous baseball number. Why is that? What's a famous 714 in baseball terms? Baseball number. Stay with us. You're listening to the best of investing. Again, call 888-912-1190 to answer that question. Welcome back to the best of investing. Edward Brown here, along with Annie Dickerson. Our second trivia question: the number 714 is a famous number in baseball. Why is that?
It sounds too high to be a batting average.
Yeah.
Is
Yes.
it
Yes.
is it maybe the number of seats at a certain stadium or
Yeah, that'd be too low.
too low?
That's how
Yeah.
many home runs Babe Ruth
Okay.
hit.
Ah,
How many
okay.
Babe Ruth hit?
Yep.
Okay. So just real quick before you get to what you were talking about. So yeah, our Pacific Southwest Note Fund pays just a flat 8.5%, and it's got liquidity. If you want your money back, you just give us 30 days notice. So it's got really kind of the best of all worlds.
Oh,
Now here's the downside. If somebody were to say, wow, that sounds really good, can I give you $1 million? I'd have to say no. I said,
yeah.
I can't take that much money because it takes us a while to pick
Right.
the loans. 300,000 here, 200,000 here. So there was a time I had to tell people literally for months they couldn't get in. Now
Wow.
it's opened up the spigot again because with the economy the way it is,
Right.
we seem to be finding some good loans.
Yeah.
But anyway, going back to Annie and good investments. All right. So again, let's get back to the how do you know which was right for quote you, meaning the investor?
Yeah. So, really, what I've discovered, and I've now been on both sides of it, what I've discovered is it really comes down to each individual person and their goals. So, if you're a person who wants control, you want to make the decisions, you want to pick the properties, you want to be involved and look at the numbers week in and week out, that was not me. But if you're that type of person, then active investing is probably going to be a better fit for you. Going out, and I was just at a conference. I was talking to some young guys who were, they were ready to roll up their sleeves and really dig into these rental properties. And they said, yeah, but maybe I'll put in 10,000 into a syndication. And I said, why? Why would you put in 10,000 into a syndication when you are ready to roll up your sleeves and do the work? If you want to do that, great. I think active investing is a great fit if you want to do all the work yourself. But if you're on the flip side, if you're a busy physician, if you're a busy parent, you've got a lot going on in life, which is the stage in life that I'm in, where I don't want to deal with that. I'm not very good at being a landlord. That's what I've realized.
But
and
also
it,
$10,000. I mean, if you were serious about that number, that's kind of can't really do too much with 10,000.
Right. Yeah, it's true. I mean, a syndication typically is, 5+ years. If you put in $10,000, maybe at the end of 5 years, you'd have $20,000, which is really not that exciting. You'd really have to invest 50 or $100,000 to really make that worth it. But yeah, but if you're on the passive side and, you don't want to do the work, you don't want to have to touch it, you don't want to have to think about it, but you also want to diversify out of the stock market and some of your other investments, then passive real estate investing through something like syndications or funds can be a great way to do that.
Okay. I know one of the things that you would have to look at, because you said you're actually doing your own syndication. What I'm going to kind of put you on the hot seat for a minute here. Uh, what are there any charges up front that an investor pays?
So all of our fees are rolled in to the investors. So for example, if an investor were to invest 50,000,
Yeah.
there's no additional fees on top of that.
Okay.
So we do have, in full disclosure, we do charge an acquisition fee that's paid at the closing of the property, and that covers all of our costs leading up to
Yeah.
the acquisition of the property. All the risk that we take on, the site
Sure.
visits that we do, the due diligence, the legal costs, all of that
But
stuff.
people can't work for free. So yeah, well, let me, I guess here in the old days, like limited partnerships, they were taking like 20% off the top. And
Whew.
that's too much. What basically gets taken off the top for you guys in your?
Yeah. So typically for our acquisition fees, we're charging between 1% and 3%.
Oh yeah, that's nothing. So, yeah, but what about the actual cost of the syndication though? Is that something you
So,
share, or does that come
yeah.
out of?
So
Go ahead.
beyond the acquisition fee, we do charge an ongoing asset management fee. And again, that's, 1 to 2% of the ongoing income for the property.
That's also fair.
And then at the end, that's where syndicators make the bulk of their money, is at the sale of the
Percentage
asset.
of
And
cost.
you want it, as a
Yeah,
passive investor, you want it to be structured that way because there's alignment of interest,
yes,
because then
absolutely,
the syndicator is incentivized to execute on the business
absolutely.
plan and really deliver. Yeah.
What's the split, you and the investors?
So our split is typically a 70-30 split,
Yeah,
70 to the investors, 30 to the general partners,
yeah,
up to a certain hurdle. And then after that point, then we go to 50-50, which again is a good alignment of interest because
yeah.
it
No,
incentivizes us to make it
listen, that's
perform
fair. I've been in this
greater.
business a long
Yeah.
time. I think that's very fair. When we come back, because believe it or not, these breaks come pretty quickly here. When we come
Hmm.
back, can you share some of your history of,
Happy to.
but you haven't been, I know you haven't been doing this for 40 years, but like, have you had certain ones that have gone full cycle?
Yes, we've
Yes.
had
Okay,
about,
good. I want to hear
yes.
about those.
Yeah,
All
we'll
right.
talk about that.
All right. So I always like to learn all this fun stuff here. Okay. Here's our third trivia question: baseball numbers. This one may or may not be hard, depends if you know it. 2,632 is also a famous baseball number. Why? All right. Call 888-912-1190. First caller with the correct answer wins that tanning certificate. Also want to make a mention for the Lakeshore Lodge in Tahoe. They have, like, I don't know, 100 or 200 feet of lakeshore uh, right on their property there. Beautiful, beautiful property. I've had some people go there who've won contests and stuff, and they've, we're not doing that this time, but they've gone and they said it's just a beautiful property. The Lakeshore Lodge in Lake Tahoe. You got to check them out. Again, here's our trivia question for the tanning certificate, which is worth over $100. 2,632 is a famous baseball number. Why is that? Call 888-912-1190. First caller with correct answer wins that tanning certificate. Stay with us. The Best of Investing. We'll be right back. Don't touch that dial. Welcome back to the Best of Investing. I'm Edward Brown, along with our special guest, Annie Dickerson. Our third trivia question: 2,632 is a famous baseball number. Why is that?
Ooh, this one really stumps me. I don't know. Is it like the number of hours or the number of
Now,
games or the
well, close. Cal Ripken's consecutive
uh,
game streak, he beat Lou Gehrig, the Iron Horse, the
oh,
Iron Man.
okay.
So that's kind of a famous baseball number.
Huh.
Okay, so Julie from Good Egg Investments, you're about to share some history with us, of certain syndications that you've done that have gone full cycle.
Yes, that's right. So, as mentioned, so Julie and I started the business back in 2018.
Huh?
In fact, I quit my job working as a creative director in January of 2018 to go into syndications. Had never done a syndication before. And the next week, I met Julie at a real estate conference, and we hit it off and formed the partnership about 5 years ago this month.
Wow.
And in that 5 years, we've been part of 40 syndications, and 20 of them
Wow.
have gone full cycle.
Wow.
So at first, we were a very small part of each
Sure.
syndication. So we would bring, some friends and family money into each deal, maybe, between 500,000 and maybe $1 million in investment. And that first year, we were lucky to be part of. It was a great time to get in 2018,
Yeah.
and we were part of 9 or 10 syndications that first year, another 10 the second year. And then as we built up that track record, we started to be able to bring more and more capital to each deal.
But again, you were the syndicator, weren't you?
Yes.
Okay, wow,
Yes.
that's amazing. I mean, because people have to say, well, gee, I guess it's trusting you, and knowing, that's a good reputation to that people would trust you, especially since you didn't have the 25 years or so
Right.
of experience. But I guess what assets were you buying?
So primarily, at the beginning, we were primarily buying B class, I would say B
Okay.
class multifamily
Okay.
in Texas
Yep.
and the Southeast.
Perfect. And you were back then, were you still located in the Bay Area? Or where were you located
Yes.
then? Okay. So how did you know where to buy in the United States?
Mm, great question. So we read a lot of books. We talked to a lot of people, and we learned, what types of markets to look for. And we realized, you got to go where if you're investing in multifamily, you got to go where the people are, because it turns out humans like to live indoors. And so we wanted to find places where there was a lot of job growth, a lot of population growth. And then as now too, Texas was seeing tons of job growth, and Florida as well, the Carolinas.
Yeah.
And so we started to hunker down in those markets and started to create connections with different teams in those markets. And so that's how we kind of started investing
It's
there.
funny because again, like I said, I've been doing this for 40 years, and in the old days, it was like no, California and nothing
Yeah.
else. And all these other states are, crazy or whatever. But with work from home and social media and the internet and all this other kind of stuff, and with California losing people,
Yeah.
because of some of the
Hmm.
crazy wackadoodle, aspects of crime, etc. You were sharp. You were smart. You did some good. Yeah, it's again very similar. Like our Southwest fund. I don't even know if we have any off the top of my head if we have anything in California. It's
Yeah.
all out of state. Um, wow. Okay. So how did you do on that? If somebody invested $100,000, what happened? What happened to their 100,000?
Yeah. So our average annual returns are north of 20% across all the deals that we've exited. Some we exited in as short as, 14 to 18 months
Wow.
if the timing was right and we were able to double and in some cases triple people's money.
Now, did you buy all
Um,
cash or did you get a loan?
no.
You got a loan?
Yeah. Everything was leveraged around 60 to
Okay,
70%.
that's pretty typical on that.
Yeah.
Okay. Yeah, and the thing is, if you're gonna borrow the money back then, you could probably borrow it like 3%.
Right.
You can, and your rents are going up.
We
And you
really
still,
got spoiled.
yeah,
Yeah.
yeah. Oh boy, I'll tell you. Yeah, it's really. You want to hear something really crazy? There was there's a very good real estate broker here in Marin County. And a couple of years ago, he was telling us that one of his clients purchased, or he sold a small apartment building, like a duplex or something, at a 1.6 cap rate. And I'm thinking, how can anyone want to? I know it was a trophy property, and maybe it was just the idea of, oh, look, I own a trophy property. Unless the rents were so low that you could raise them, but I don't think they were. So it was just the idea of, okay, great, you just invested your money at 1.6%.
Yeah.
Terrible. I mean, to me,
I
that's
know.
terrible.
I mean, it reminds me actually, I'll tell you a quick story. It reminds me of a real estate investing class I went to in San Francisco a few years ago. And the teacher led the class through analyzing this one property.
Yeah.
And at the end, it was a $17,000 a year loss, okay, on cash flow. And
Yeah.
then she asked, and I'm sitting there scratching my head. I'm like, why are we even looking at this property?
Yeah.
And then she asked the class, is this a good investment? And almost invariably, everybody said yes because of the appreciation. So everybody it was like they wanted to invest for the
Wow.
appreciation. I'm like, oof,
That
that's a
can get a
risky
little,
proposition.
yeah, that's kind of scary because what happens
Mhm.
when the appreciation low? See, that's why
Yeah,
I like, as Kevin O'Leary says in Shark Tank, I like cash flow.
right.
Want to see cash flow. Wow,
That's
yeah,
right.
because you can go broke having did the professor
Yeah.
did she think it was a good investment too?
She did. She did. I was shocked.
Wow. I mean, I guess if there's a now, that is kind of a caveat because what happens if, let's say, it was only 30% occupied, and that's the reason
Mm,
for negative cash flow, and you could potentially increase the occupancy, and you really realize you were buying it at like $70 a foot or something,
right.
then potentially okay, that
Yes.
can give you a reason to say, you know what, I'll do the negative cash flow for a while.
Yeah.
But I don't know. I wasn't there, so I don't know how
No,
to pay.
this one was fully occupied.
Oh my
Renters were
God.
locked in. Uh,
Yeah, and if
yeah.
it's in San Francisco, rent control.
Yeah.
All right. Tell you what, stay with us. You're listening to the best of investing. We're going to be coming back with some closing comments. Don't touch that dial. Welcome back to the best of investing. Last time for today, I'm Edward Brown, your host, along with my special guest, Annie Dickerson of Good Egg Investments. So, Annie, what markets are you investing in now? What do you like?
So these days, we're investing a lot in Arizona,
Okay.
Texas, and the Carolinas and Florida. So a lot
Now,
of the Sun Belt markets.
is it still multifamily?
Primarily multifamily, that's our bread and butter. But we've also kind of gotten into hotels.
Really?
And so for hotels, we're actually investing in the Midwest because we have a great partner there. And we're not investing in the fancy, with all the bells and whistles kinds of hotels, the
Yeah.
tourist hotels.
Yeah.
We're investing in what are called select service hotels, which, they have minimal amenities and they're really geared toward either long-term stays or
Gotcha.
business travel. And so they're kind of tried and true, nice, stable cash flowing
I was going to
assets.
say, because, that trying to manage a hotel, now you got employees and that other stuff,
Yep.
whole different animal. It's interesting with when people ask me like, well, what's going on with real estate? Because again, we're managing all these funds. And I just published an article on this where I said, I don't see a crash happening. 2008 and all that, you had situations where there was like stupid money because people could just get loans not having to show ability to repay. Now you have to do that. But the other part is that you've got a lot of people who refinance at fairly low rates and they can't afford to move, so to speak, right? Because they're not going to be able to replace a 2% loan with an 8% loan or 7% loan or whatever. But the multifamily market part is still really good because you know what? Everybody needs a place to live. I don't care
That's
how bad
right.
things get. I'm not going to live in a tent. Now I may have to
Yep.
downsize, right? And I talked about this before that no matter what your stance is on the illegal immigration, the 6.5 million people coming in, um, they all have to live somewhere.
Mm-hmm.
So it's going to create some kind of demand,
It's true.
and probably in those B properties,
Yeah.
and C properties
Mm-hmm.
too. Wow. But hotels, that's a whole different animals. Wow.
Yeah.
How often do you go out and visit the properties?
I was just out in Phoenix last week, actually walking a property. So I love walking the properties, getting to see the progress and everything. We send our either one of us or our asset manager, we try to get out there once a quarter or so.
Okay. With the hotels, um, how do you analyze those compared to regular multifamily? 'Cause, I mean, if you have long-term stays, that kind of makes sense. But, do you try to get 75% occupancy? I mean, there's a whole different analytics on hotels. Yeah. No, I can't hear you. You cut out. I can see your lips moving. The audience can't, but I can see your lips moving. But I'd love to repeat it.
How
Oh,
about
there we
now?
go. Okay.
There we go.
Okay.
Yeah, so the occupancy, the numbers are definitely very different, and we're so grateful to have such a great partner
Okay.
in the hotels. You know how a lot of
Yeah.
hotels, especially like the Holiday Inns, Hampton Inns,
Yeah.
Homewood Suites, you look at the ratings and the reviews on Google, and they're
Yep.
like 2.9,
Yeah.
3.2. Well, this partner, they're so good at managing hotels that all of their hotels are at 4.5, 4.7.
Wow.
So it really creates good return guests.
Good. Yeah. Actually, I'm planning on staying at a Hampton in North Carolina. Uh,
Uh-huh. There
yeah,
you go.
down near Wilmington on that. Well,
Nice.
Annie, it's been a pleasure. You got to stick around. Here's our thoughts for the day. Oh, by the way, how do people get a hold of you if they're interested in what you do?
Absolutely. The best place to go is our website, goodegginvestments.com. We've got tons of great resources, whether you're just starting out or you're a seasoned investor, and you can click our Start Here page and you'll get to know how to work with us.
Great. Well, thank you very much. Okay, here's our thoughts for the day. So I thought the dryer was shrinking my clothes. Turns out it was the refrigerator all along.
Ah, ah.
And I only know 25 letters of the alphabet. I don't know why.
Oh,
Great. You like that one? Okay, we always have dad jokes here.
good.
Okay, tune in next week to The Best of Investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.